Today on the channel, we're going to be selling puts on UPS, a stock that we liked, that we talked about once before. So let's get straight into it. Okay, before we get into selling these puts on UPS, I will ask you to please like and subscribe to the channel so we can get this channel to grow. And also remember that we sell The Culmination on Amazon. We go over almost everything within that book that we go over that we talk about today. So the first thing we're going to talk about is selling puts on UPS, and we're going to actually do that live here today for you. But what I first would like to talk about is what exactly is a put. A put is given the we're selling, I call it selling insurance. So we're going to sell a put and someone else is going to buy that own the UPS shares. And what they're doing is they're getting protection in case their shares fall down, and we're giving them that protection, which is why I call it like selling insurance. So the strike price that we're going to use today is 132. The stock is selling around 135. So we're going to insure it for 132 for the June 21st, which is this coming Friday. It's right now, today it's Monday the 18th, and we're just going to insure it out. Well, I'm sorry, Monday the 17th, and we're going to insure it out until the 21st. And also remember, it's Juneteenth on Wednesday, so we're only actually selling that for 3.5 days. And we're going to see how much a premium we can get as we go through this with you. So what we're going to do is we're going to put in the symbol UPS, and we're going to sell a put option. And so when we say we're going to sell the 135, the 132 strike, the stock is at 135.62, and we're going to sell the 132 strike, and we're going to sell it with the June 21st expiration. And since it's at 135, that'd be, remember, one put option represents 100 shares. So that's like 13,500. So we're going to sell two. So we have to have about 20. We're going to have about $27,000 that we're going to be insuring. And right now that is selling the medium for 18. So we're going to put our medium price. We're going to put 18. You can also click on here and it'll go right in there. And we're going to sell it for a limit. So that's the trade that we're going to do today. The reason why we're willing to buy UPS at 132, we made a video in the past about why we like UPS. UPS is down from like 240. They've been going through troubles. They just signed a big union deal. Their labor went up by a lot. So they reported last quarter, they reported pretty bad earnings. So the stock slid. You can see it has a 52-week low of 132. So even at 132, we'll still be getting it below the 52-week low stock price. So we think it's a good buy. We think it's a good company. We think it's a long-term durable company. And we look at it one or two ways. We can, if it did come down to 132, we would reposition. And reposition is basically either we'll be rolling it out or rolling it down at a lower strike price, which we will go over here. We'll add another chain to try to give you an example of exactly what's that like when you roll down a stock. But that's one thing we do, or we can keep the position. If the position is assigned to us at 132 and we're happy, at about 132, they'll be paying like a 5% dividend. And we would like that. Oh, we did forget to show you how much money we would get on this trade. So let's go back to that. So for trading for 1 week, so we're gonna sell it to open. I'm sorry about that. We're gonna sell it to open. We're gonna sell it at 18. We're gonna put in a limit price at 18. So it'll give us $36. And that may not seem like a lot of money at selling insurance, but all we're doing is we're just saying we're willing to purchase the stock at 132 if it goes down that low. If it don't go below 132 by the close of business on Friday, then we keep that premium. And the way we like to look at it as it's something that's generating cash flow for you. It's adding income. And if you get several of these positions, or you like several different stocks like this, you really start earning some good weekly income. And sometimes you can go a little bit higher, as you can tell. Let's say if we wanted to take a little bit more risk, we can go up to 133, and it'll pay us $60 to insure that. But we're more comfortable at 132. And as I said, we actually don't plan on having these shares get assigned to us, but we're willing to, if they do get assigned to us, we'll be happy with them. We can hold a position for a long term because this is a position that we're going to like for the long term, or we can roll down that position. And when I talk about rolling down a position, I'm just trying to give you an example here. So let's say we have to suppose for a moment that we own the 136, the 136 strike because that's below, and we would have to roll it out, or we can go with 135, and we can say that we're a little uncomfortable right now, so we're gonna buy this one to close because we're gonna act like as if we own the position, and then we're gonna sell this one to open. And what we're gonna do is we're gonna look to see if we can roll it out or we can roll it down. See what the best how much, and we only do this at a profit. So let's just suppose for a moment right now, the stock was at 135. We was a little uncomfortable on the day that the stock is trading at. So we can come here to 134 and let's see what type of premium that it would be paying us. So if we bought this, if we had the 135 strike and we was a little uncomfortable, and let's say it was on expiration day or the day before expiration day, and we wanted to roll this position out. So we would buy back the 135 strike, buy it to close, and then we would sell to open the 134 strike. And as you can tell, it'll be a profit, it'll be a credit of, we'll go with the median of 46 cents, and it's just going, which would bring us $92. So not only are we lowering our stock price, we're extending it out for another week, but we're lowering the stock price by $1 in this example, and we're actually making 92 cents to roll out that position. So that's something that we try to do. We don't never really want to be assigned a position unless we really want the stock at that time, but we only do puts on stocks at the stock prices that we're willing to own at that price. So again, I mean, we like UPS. UPS is a good company. We think the company is going to turn around in the years to come. I mean, they're paying a 5% dividend. So like I said, if we was assigned this position, we would be happy to own this position. But let's go back to just as if we were just selling our put, just to kind of repeat. Because remember, we're going to sell the 132 strike. The stock is moving up, so the premium is coming down a little bit. So let's act as if we're going to do the 133 strike. Remember, again, this one is until June 21st, and we have to change this to sell to open, and then we have to review our trade. So that's reviewing our trade. That's what would happen if we sold this. It'll be $62 going into account. I like to joke around and say, I sit in my basement and I print money. And that's exactly what we think we're doing here. Again, if you like this content and you like to see how, if we think you're helping us, we're helping you at making money, please subscribe, please like, please share. Let your friends know about it. We're going to have a lot more content coming your way.